The stock market has been going up for weeks now since the crash back in March. However, yesterday, Thursday, June 11th, the stock market had one of its worst days. Bond king Jeffrey Gundlach recently called out the stock market, stating that it was due to fall from its lofty perch. Gundlach estimates that a wave of higher unemployment will continue to push the stock market lower. The Dow Jones dropped yesterday by a whopping 1,800 points. That's a loss of 6.9%. The S&P 500 is down 5.7%, and the Nasdaq has fallen 5%. The VIX Volatility Index is up by 30%. So, why did the stock market drop significantly in one day? And what can we do as investors to prepare during this time? First of all, there are several possible reasons for this behavior from the stock market. Number one, we have seen an increase in the number of infections and hospitalizations in many states across the US. As states are starting to open back up, many of them are recording their highest 7-day average of new cases since the pandemic began. Hospitalizations in at least 9 states have been on the rise since Memorial Day. In many states, there have been an increasing number of patients under supervised care since the holiday weekend because of the infection. The spikes generally began in the past couple weeks and in most states are trending higher. This brings about the possibility of a second lockdown and the reinstitution of economic activity restriction measures, and the stock market is starting to factor that in. Another possible reason is that investors are starting to realize that the recovery is going to be longer than they originally expected. This follows a bearish sentiment from the Federal Reserve. Federal Reserve Chairman Jerome Powell made an announcement on Wednesday that the economy is in bad shape and the unemployment rate is projected to remain high for years to come. That's why they are easing monetary policy to the maximum level, including buying large quantities of bonds and leaving interest rates near zero until at least 2022. Many investors see this as a very serious sign of troubled economy, and thus they are getting nervous and choosing to get out of the market. So, what can we do to profit or protect our investments during these times? If you are a day or swing trader, you might want to take advantage of these market drops by trading instruments like TVIX, since when the stock market sells off, the volatility spikes, so you can use TVIX for a short period of time to make huge gains during these wild moves in the market. You can also try using a leveraged inverse ETF like ISDAO, which works in the opposite direction of the Dow Jones Industrial Average Index times 3 on a percentage basis. So when the Dow Jones goes down, ISDAO spikes up. If you are a long-term investor, then you can try to hedge your portfolio by buying some put options or using regular inverse ETFs for a short period of time, so that if the market continues to drop, you will be able to recoup some of your losses. For a long-term investor, using an inverse ETF that does not have any leverage like SH, which works in the opposite direction of the S&P 500, might be reasonable to hedge your portfolio for a short period of time. Also, having a portion of your portfolio in dividend stocks could be another thing to consider here. There are many good recession-proof companies that pay a nice dividend like AT&T, Coca-Cola, Pepsi, and Kraft Heinz. Finally, I want to add that now is the time to look at your portfolio and make sure that you only have solid, well-capitalized companies with good balance sheets that will make it through a possible recession and recover fully afterwards. That's all for this video. Thanks for watching, and I will see you next time.